Everyone, welcome to Kiss My Assets podcast. I'm your host, Kyle Macdonald, here with the CEO of Neighborhood Ventures, Jamison Manwaring. How are you doing today?
Hey, good morning. Doing well. Have a lot of exciting stuff going on in the world of assets, and especially with stuff we're going to talk about today with housing and multifamily.
Yeah, absolutely. It's another beautiful day here in Phoenix. Got some palm trees behind us, and we're here to dive in. Every week you and I are constantly looking at the market from a macro standpoint, and then of course we dive into micro markets, especially here in Phoenix. And for our viewers, we see articles every week that really jump out, things that we want to discuss in depth. And one that really jumped out this week was a Wall Street Journal article talking about how renters across the entire United States have enjoyed, easing prices, easing rental rates, and it's really becoming more of a renter's market where they have the upper hand on landlords. Just a key data point here, national average rent fell about 0.3% in September, the steepest September drop in 15 plus years per CoStar. And, Sun Belt and Mountain West markets like Phoenix here, Denver, Austin are seeing some of the steepest rent reductions they've seen in quite a long time. What does this, Jamison, what does this signal about supply and demand imbalance in metros like Phoenix, like Denver?
Yeah, the funny thing is there's a lot of media articles right now that rents are too high. How do we lower rents? Things are not affordable. The reality is that rents in our market in Phoenix have not gone up in 3 years. In fact, they've gone down slightly. Mm-hmm. And it's been because the developers and the builders have done the right thing and they've added more supply to the market. But it is very affordable to rent right now. It isn't affordable to buy a house for most people, but renting is very affordable. The amenities that are offered are better than they've ever have been. And that's why more people are choosing to rent, choosing to live in either a brand new build that has great amenities, a renovated property, or any other group of A, B, C type of apartment that's out there. And they do have the upper hand today because most markets were oversupplied, at least in the short term.
Yep.
And so I think it's important to, as investors, to understand that there is a lot of opportunity right now with multifamily because rents have been lower for quite a while and wages have gone up. So even though the supply has kept rents flat, the folks who are renting those buildings, they have more income.
Yeah. And
they haven't had higher rent. So there's an opportunity now for over the next few years for those rents to kind of pick up back to the market. Mm-hmm. And the other thing that I love about where we're at today is this was not driven by the government coming in with some heavy-handed solution. This was driven by free market forces and builders saying, let's build. There's opportunities. And they overbuilt, and now renters are benefiting from it.
Yeah, renters, you can thank all the developers out there for helping you out.
Absolutely.
That's and speaking of the upper hand, landlords, they of course recognize that, and across all these markets that this article mentions, there's a key data point here I wanted to point out. Landlords offered concessions on 37% of rentals this past September, a record high for that month according to Zillow.
Yeah.
Dive more into that. Could you talk through a little bit of what typical incentives look like with these concessions as an operator and landlord yourself, and kind of where you see that going from a trend perspective?
Yeah, and I was at the Zillow Rentals conference last week, talked to a lot of operators, and it's obviously very local and very specific to the market that you're in. But in order to lease up some of these new builds, they're getting very aggressive. I haven't heard more than 2 months very much, but I have heard more than that occasionally where people get 2 months essentially free rent. Mm-hmm. And sometimes that's carried over the life of the lease, and sometimes it's all up front. But The concessions are very high on a relative basis to where they normally would be. It isn't unique if you were going to get a month rent free at a new build as they're trying to lease up 300 units in a short period of time. But concessions are high, and then that has a trickle-on effect to the other units in that market, because there might be some folks who would never look at moving, but they see an ad on Zillow that's 2 months free rent, and that actually on average puts their rent lower than their Class B building, and they can move into a Class A building. Now they just have to realize that once that concession burns off, their rent is going to be higher there, but it does get some people moving, and it has kind of a trickle down effect into not only the new build markets, but all the other, or the new build buildings that offer these big concessions, but to everyone else. So typically what we're offering for new move-ins is a month concession. And in a normal market, we don't have to offer that concession, but today we do.
Yeah, that's actually, and that's quite conservative compared to some of the other assets that I've seen just driving around here in Metro Phoenix. I mean, there's probably 3 apartment complexes within a half a mile where we're sitting that have advertised 2 months free rent right on their front doorstep.
Yeah, and what that indicates is that they're in some sort of form of a lease up. They're trying to get a lot of units filled. And the other side of that are stabilized buildings. So you have buildings that are going through a lease up process, and most of our buildings are stabilized, and that means they're 95% occupied. And that's where things are maintained today are strong, is that renewals are strong. People are staying where they're at more than normal. You do have some impact from the concessions, but it isn't overwhelming. And as long as those you have a stabilized building, you're still in a full occupancy state, those buildings are doing well. It's the buildings that are doing the lease up. They definitely have an impact. And at some point, and this is what we're all looking at, is that the new construction and the delivery of those buildings, that kind of expires, and we won't have as much anymore. And one thing that the Wall Street Journal article talks about is the process has kind of been extended, and construction deliveries have been extended. So it's kind of and that's due to delays, construction delays, getting permits. And so this period that we're in right now has kind of been extended more than we expected. We expected now to be more into a more normal market where a lot of this new deliveries would have been absorbed, but it's been extended a little bit longer. So we're looking at, it's probably going to be into next year in a market like Phoenix, where we've had so much new supply, and we're number 3 in new supply 3 years in a row before we get to that normalcy.
Gotcha. Yeah. And so just to cap that off, concessions, short-term marketing tactic, or is that more of a long-term structural shift that landlords have to make?
No, they'll always be in place in a rental market for new lease up. And right now they're just very aggressive about it because there's so many units to lease up. So as those units get leased, and in Phoenix we are seeing a ton of absorption, which means they are getting leased. As they get leased, and we don't see a new glut of supply, then we'll get back to a more normal market. And kind of on top of that, the last data point I really thought that was key here was a lot of analysts with Yardi Matrix, one of the largest databases for rental information across the country, are forecasting 2027 rent growth downward right now. I think, and maybe you could speak to this from the Zillow conference, some of your previous conversations, but a lot of owners have been hoping to regain pricing power this year, 2025, and now people are starting to push expectations towards 2026 and 2027. This rent recovery being delayed another maybe 1 to 2 years. How do you think
multifamily operators and investors should adjust their underwriting assumptions based on rent growth, based on exit cap rates and hold periods?
Yeah, I think that it provides an opportunity for the folks who own buildings and are operators to focus on their fundamentals.
Yep.
Because rent growth isn't going to save them. So you have to go and make sure that you're maintaining good occupancy. You have to focus on renewal.
Yeah.
You have to make sure the folks who are living there want to stay, and how do we incentivize them to stay?
Yeah.
How do we make this a great place to live? Knowing that, as the saying goes, this time will pass and we'll get through this. But right now, that's the mission, is to make sure that the existing units that you're managing and that you have are running well. Because we don't know when that is going to occur. Some data was pointing to this year we got to kind of a more fundamental stabilization, and then rent growth would occur in 26. Now, maybe that's pushed out a year. Maybe it's 26 is another flat year, and rent growth occurs in 27. We don't know. The thing from my background in before I got into multifamily was in technology stocks is they move up and down 25-30% in every quarter as they reported earnings, and that wasn't uncommon.
Yeah.
So we haven't seen rent growth, but we haven't seen a big decline in rents either. So rents in Phoenix are basically flat, maybe down 1% this year.
Yeah.
So you can get through it as an operator. People still need a place to live.
Mm-hmm.
There's always going to be a need for housing, and the bottom isn't falling out. The growth just isn't going to be there until we turn that corner.
Yeah, especially here in Phoenix, right? But other markets probably aren't as lucky.
I was talking to a woman who at a very large group. They own several thousand units, and they just bought a building, and it was an opportunity for them, but the building was 25% occupied. It's Florida market. And the prior owner had done a bunch of things, and they could never get above the 25%. And this operator had been operating it for a while now, and they still hadn't seen a lot of movement. So there's definitely, there has to be enough demand from new renters coming in, and there are some markets that don't have that demand. We're lucky to be in Phoenix because we have consistent demand. We have consistent migration here, and that is going to continue to be strong, and that helps us out. As long as we make good decisions, we'll continue to have strong demand here, and that's one of the tailwinds that we get.
Yeah. Wow. Yeah. That's interesting. I wish I was in some of these circles that you're in. It's amazing. Yeah. Well, there's a lot of unpredictability. I wanted to kind of move on to this next article that really jumped out at us this past week, talking about how a lot of investors in multifamily are confronting unpredictable cap rates. Okay. Key data point that I really zeroed in on at the beginning here was cap rate spreads are showing up to anywhere from like a 50 to 75 basis point difference in cap rates. Really, I mean, depending on operator model, market, and capital structure. And this is a national article, so not Phoenix or Denver or Austin focused. What do you think? What is driving this fragmentation in cap rate pricing, and does it mark the end of an old national average playbook investors once relied on for underwriting consistency?
Yeah, there's a lot of debate around cap rates, what an exit cap rate could be in 3 or 5 years. And the reason why there is so much debate around it is because if you've ever done any financial modeling, if you have a cap rate of 5 versus a 6 on your sell, it's night and day on the return model. Yeah. So it may seem like a little variation at the end, and but it can be pretty dramatic. And then the other part of it is you can argue till you're blue in the face about it, and you really have no visibility into where cap rates are going to be down the road. And one of the, I think, most important things to realize today is that cap rates are not all just tied to interest rates. Interest rates are going to have some impact on cap rates,
Yep.
but rents and rent growth, as they're forecasted, is really a huge driver of cap rates, because especially as you look at a pro forma and you look at, okay, what's a property going to do in a 3 or 5 year period from a growth standpoint, and then you put a cap rate on that period, it's going to be different if you're in a growth market or if you're in a tertiary market that doesn't have the growth, because it's not just about, you know, what's the debt going to be or the cash flow. It's more about what is the growth and what can the rent growth profile look like. So cap rates are a great topic that's never ending. That's part of it.
Sure.
I can tell you right now, if you're a new vintage property in Phoenix, you're going to get a cap rate of about a 5 exit today. And older vintage is not getting that strong of a cap rate today, but in other markets that has not always been the case. You know, let's say an older vintage, just for argument's sake, a 60s vintage is more of a 6 cap, or a 5 3/4 cap, where new vintage is a 5 cap. In a normal market, those are more compressed, and right now we are seeing a divergence in those two cap rates. And I think part of it is because institutional capital is favoring new build, and that's a large chunk, the largest chunk of equity capital comes from institutions. They prefer new build today. They've kind of this fleet of safety of new builds, and they're not as interested in older vintage. And so that's part of why cap rates remain really strong on new builds. I also think that's where an opportunity is, because as we get into more of a normal market, which we will, then and you can buy an older vintage building that's well run, well located, people love living in, you're getting strong rents, then I think those cap rates will get closer to newer vintage in a normal market, and that's really a great opportunity for an investor.
Yeah, a lot of moving parts there. And one thing that we haven't touched on that this article really hammered on was talking about all the maturing commercial real estate loans coming up within the next 3 years. Specifically, about $3.3 trillion in commercial real estate loans are nearing maturity in that time. 43% of that 3.3 trillion is exposed to multifamily debt.
Yeah.
Right. That's a big number. I mean, that's, close to, that's over that's about 1.2 trillion. What does that do to lender behavior, investor behavior, shaping kind of future valuations for this asset class?
Yeah, and a lot of those loans will be extended. They'll be renewed. The good part about it is we've seen some relief with interest rates. So the rate at which those could be extended has improved. What we've seen so far is that most lenders have worked things out with their operators. They've either extended and in some cases pretended. In some cases, they've required some principal buy downs. But this big wall of maturities is kind of starting to work itself out, and we haven't seen, big numbers of foreclosures and big distress. There's some, but they're pretty hard to come by, and we go after those, and we spend a lot of time hunting those down. But so far, it seems like lenders are working with the operators rather than bringing a big heavy hand in. That can definitely change.
Yeah.
I've talked to some folks who think in 2026 most lenders are kind of going to draw a harder line and say, look, You either need to refinance this, you need to recapitalize this. And so we will see if that ends up happening.
I think that prediction possibly could come true, because also delinquencies this time of year are roughly double of what last year's level was. Now around 4% of total multifamily debt. But it's still not really at crisis levels, right? Yep. And so, the uncertainty in debt costs is, I guess we'll really just see, right? It's so case dependent, because you could have a debt fund that has much more flexibility. You could have a traditional conventional lender who is maybe more hardball.
Right.
It really is case by case, right?
And that's what we've seen so far is we bought one property in foreclosure earlier this year, and that was because it was a lender.
Yeah.
And it was a bank, and the bank had actually bought a portfolio that included this loan. And when they bought that portfolio, they didn't care anymore about working with the operator. They said, "You're delinquent, we're foreclosing," and we went and bought it in a foreclosure auction. But in other cases where it's a debt fund or they have some flexibility, so far we're seeing quite a bit of flexibility from them.
Yeah, great. Well, let's move on to the last and final article that we were looking at. So this is from GlobeSt. It talks about how multifamily forecasts point to slowing rent growth through 2026. And I know that we've touched a little bit on the subject earlier in this episode, but wanted to kick this off with another kind of macro data point. So jumping into this article, Q2 GDP for the national economy grew about 3.8% annualized, but hiring slowed to only about 100K jobs in July and August, and less than 1.5 million jobs over the last 4 quarters. So not the greatest. And then the Fed, as you mentioned, just had a rate cut of 25 basis points in September, with another, maybe 1 or 2 expected by the end of this year. A government shutdown also began Q3 amid tariff and political uncertainty. And so my question to kind of start this off is, with growth strong, but labor weakening and, a little bit of disinflation, how should investors update NOI growth, exit cap, and just some of the basic underwriting assumptions based on these kind of macroeconomic data points? Yeah,
we've had some uncertainty in this year, 2025, and now we're in a government shutdown that's about to turn into the longest one the government's ever had.
Yeah.
And then we certainly have seen businesses pull back hiring because of this uncertainty, and that's part of what I think it's important to understand is when businesses and business leaders don't know what to expect, they just don't do anything. Mm-hmm. And so certainty can be really helpful, and it's what Wall Street, and we don't love Wall Street per se, but it's what investors want to see, because they know if there's certainty and a business is doing well, then that business will reinvest in the business. But if the business is doing well and there's uncertainty, they may not invest in the business. They may not hire more people. They may not buy more products.
It's almost a paradox. Like they stifle
themselves. Even if their business is going well, they're just going to be more cautious. So this has definitely been, with the new administration, a year of a lot of uncertainty. Mm-hmm. And that continues. So as we look into 2026, there's the good thing is the Fed is lowering rates. That improves debt financing for buildings, for operators, and it looks like we're likely going into a cycle of lower interest rates, where we've been in a restrictive cycle since COVID, since interest rates went up and since inflation went up. So now we are likely going into a cycle, and that should be good for us as operators. And the Fed is also doing that to hopefully stimulate the economy to increase some of the opportunity for wage growth. I can just say for a multifamily operator, you want to see people getting jobs. You want to see people moving from one place to the other because they have a new job opportunity. So I'm hopeful that these moves by the Fed will incentivize that. I'm hopeful that some of the stuff with tariffs is starting to get figured out, and it does seem like it's kind of 2 steps forward, 1 step back with that, and we can get to a certain stable government. If we do, I do think, which I think the administration wants to get to, we could be in a really good spot, lower interest rates and some more stability, but we're definitely feeling right now some of that uncertainty.
Yeah, absolutely. And there's so many data points we could talk about from a macro perspective, and we touched on job growth, GDP growth, supply and demand metrics. But this article is talking about slowing rent growth through 2026, and I think that kind of paints a picture of where we're heading here, because RealPage, which is a pretty prominent company that helps project effective rent growth for the entire country, their effective asking rent growth, they're projecting sub 2% for on average for the country through Q3 of 2026. For example, here they're saying 18% of the top 50 markets in the country, rent growth will be anywhere from 3 to 3.9%, but then 50% of the overall of those markets will be anywhere from 2 to 2.9%, and then 15% of those anywhere from 1 to 1.9% for forecasted rent growth. So,
and that's how some of these macro things, they're projecting how that will impact rent growth, and I think that what we're seeing now is you can kind of try to forecast about a year out. It's looking like through 2026, we're still in a period of where the multifamily market is absorbing all of the new inventory we have. We now are going to have some new things to deal with slowdown in jobs. So 2026 is looking like maybe it's a year of trying to get some stability.
So if that's the case, that the base case going forward for at least maybe the next, let's say 12 months, or that rent growth is sub 2%, as an operator yourself, what are the top 3 most important things for you if in your underwriting you're forecasting sub 2% rent growth?
Yeah, the existing buildings you have, you got to have great operations at those. So that's where you start. You focus on renewals, you focus on great operations. For new buildings, if you're gonna go look at a new opportunity, I think you have to look at the buildings where you can get a great price. You have to think about where are the opportunities in our market to go buy stuff at a great price, because there are going to be folks who bought a few years ago. They're not going to be able to see it through with some of these weakening fundamentals. Maybe they thought that things they saw a very rosy picture, and it hasn't been rosy since they bought the building.
Yeah.
And so as a investor, you have to go and take advantage of those opportunities to buy some of those buildings. So that's what we're trying to do.